when and why should you switch from trading micro contracts to full contracts? Okay, you have to know the answer to this question. Now, the first thing to understand is, what are micro contracts? Okay, so very briefly, micros futures contracts are smaller size futures contracts that allow individual traders and investors to participate in the futures markets with lower capital requirements compared to the standard futures contracts. Okay, so in a very basic sense, if you're trading the full ES contract, okay, you are going to be having an exposure of $12.50 per tick. Okay, if you're trading the micro, it's only $1.25 per tick. So it's 1/10 of the notional value, or 1/10 of the risk. Okay, so ultimately that is what a micros contract is versus the full. Now, the history of micros futures is not something possibly many traders know about. Why? Because it's a relatively new history. Micro lots only came about in 2017. Okay, when I started trading in 2011, there was no such thing as micro futures. We only traded full contracts. Okay, now, the first micro futures contracts were introduced by the CME Group in May of 2017, and they started quite obviously with the most popular futures contracts, including the ES, including micro gold futures, as well as the oil micro futures. Okay, so they went after the most traded or the most liquid markets, and in a moment you'll understand why. Now, why did they create these products? What was the reason the CME, created micros? Firstly, these contracts were designed to provide individual traders with a cost-effective way to access the markets. In other words, ultimately, when I started trading, okay, if you had less than $20,000, you didn't even bother trading futures. Right? It's also why, if you go back 5, 6, 7 years ago, many traders were just trading Forex. Why? Well, because that's the only place they could deploy 1 or 2K or 5K. Okay, many traders were trading equities, or at least derivatives of equities. Why? Because that's the only place you could deploy 1 or 2 or 5K. Okay, the reality is that unless you had 20 grand or more, futures were not, if you wouldn't really have been trading futures because you couldn't manage risk in an effective way. Okay, so the CME thought, well, hey, if we want to get more traders into the futures, we need to create a product that was more cost effective. Right? That was the number one reason. They wanted to expand the market to which futures could be accessible. Now, they also did it because it made hedging more nimble. Okay, now note, for example, with a one lot in the S&P, the full contract, you have a notional value of around $200,000. Okay, roughly speaking. Obviously, it depends where the price of the futures is, but roughly speaking, call it $200,000. Now, when you're trading a one lot micro, you've got 1/10 of that. Okay, in other words, $20,000. Now, for very big portfolio managers, all right, if you're trading a full contract, you're hedging in $200,000 increments, which is quite a big chunky increment. Okay, so if, for example, you had, had $1,050,000 exposure and you wanted to hedge that, it would be quite difficult to do the full contract given the increments. Okay, so it was created, the micros are created to enable hedgers to ultimately be more nimble when it came to hedging their portfolios. Okay, micro futures contracts were introduced to the financial markets to address the barriers that individual traders and small investors faced when trying to participate in futures trading. Okay, in other words, the smaller contract size makes it more accessible for retail traders, and it allows them to engage in futures trading with less capital at risk. Okay, so basically it was breaking down those barriers, saying to all traders, whether you have a 1K account, whether you have a 2K account, you can now trade futures. You don't have to go onto your brokerage platform and trade a derivative of the future. You can just trade the futures directly through the CME. Okay, so it was a fantastically smart business decision from the CME. It was very, very clever. As a result, you now also have Eurex following. You've got mini DAX contracts, etc., and you will most likely see more and more micro contracts becoming available. Why? Because it gives traders access to more markets to trade. Okay, now this sounds like a really good product. We can all agree and go, well, yeah, I mean that's really clever, really good product. Okay, but there are some drawbacks to micros, some very important drawbacks to micros, and you have to know this. particularly if you're trading micros, okay, which I suspect most of you should be doing, unless you are a very well experienced trader and you've got more than 30-40k in account. You're most likely trading micros, and there are some drawbacks, and I want you to know those, okay? But before we get to that, let's actually look at the advantages, okay? Because there's some very clear advantages as to why you should start with the micros, okay? First and foremost, accessibility. In other words, micro futures contracts make it easier for everyone with small amounts of capital to participate in trading futures and gain exposure to all the various asset classes. Okay, in other words, why would I trade futures on, or why would I trade a derivative of the future when I can just trade the future itself? Okay, remember when you go on to, for example, your IG platform and you go and trade the Bund futures, the reality is you're going to be crossing the spread. Right, you might as well just go into the CME and trade the micro of it, because one, you're not going to cross the spread. You're probably going to get better pricing as well. Okay, so very important, accessibility. Next, lower risk. Okay, the smaller contracts allow traders to manage risk more effectively. In a moment, what I'm going to do is I'm going to get the Tradelo application up. I'm going to show you a little demonstration of what I mean by effectively being able to manage risk with the micros. Okay, number 3, flexibility. Micro futures enable traders to fine-tune their positions and strategies more precisely. In other words, if you were trading a full contract, you can only trade one lot. Okay, now let's say you want to scale out of that. Guess what? You can't scale out of one lot except for getting out of it. If you have 10 micros, which is the exact same position in the market, you can scale out. Okay, equally, you can build positions easier with the micro lots. Okay, so you can buy maybe 5 and buy 5 more when it starts to feel right or the momentum comes in, etc., etc. So you've got full flexibility when it comes to micro futures. Okay, diversification, right? Micro futures contracts provide you with the opportunity to diversify yourself and trade multiple products. Okay, so again, typically when I started trading, the risk manager said, you've got 600 pounds of risk today. Now, what that meant was I could only trade one contract in the E-mini S&P, and moreover, I could very rarely have one lot in the S&P and one lot in the gold, because guess what? If they both went wrong, I was probably stopped out on the day. So I had no ability to diversify and trade multiple products because of the inability or the risk available. And then lastly, learning and experience. And this is a key one. Novice traders can use micro contracts to gain experience and learn about futures trading without having to commit a significant amount of capital. In other words, put your $2,000 in the market and learn as cheap as damn possible. Okay, when I started, again, I know I'm referring to when I started, but when I started, guess what? You had to put down 20 grand, you had to learn trading one lots, and the reality is you are most likely going to burn through a lot of that in your learning experience time. Why? Not because you're a bad trader, but because it was expensive. All right, you're risking $12.50 per one lot versus $1.25 versus $12.50. Okay, so you can learn a lot more and experience a lot more and give yourself more exposure to the market. And one more important thing. When I started trading, it was very much about start on the sim, okay? And unfortunately, there was quite a difficulty in transitioning from being a sim trader to being a live trader, okay? So the advice we were always given is try and go live as soon as possible, because the real learning experience only begins when you're live. Now, obviously, back then, like I said, if you were trading live and you were inexperienced, you were likely to lose most of your trading account, or at least a large portion of it. Okay, not because you're a bad trader, but because it was expensive. Now, however, you can technically trade live quite soon after being exposed to the markets, because it's going to cost you very little. Okay, so it's just a very different dynamic with the micros, and by and large, I would say it's a very big positive from the CME. Okay, micros are fantastic contracts, but, and now let's talk about the downside, because there is a catch. Okay, now quickly, just let's go onto the tool. And what I'm going to just show you is I'm just going to show you how positive the micros are and kind of illustrate to you the drawback of micros versus the full contract. Okay, so what you're looking at here is the risk manager in the Tradelo application. Okay, now what I'm going to do is I'm just going to load a trade. Keep in mind, this is a demonstration. Nothing you see here is real. Okay, the first thing I'm going to do is I'm going to load the MES, and let's say, for example, I have a 20 tick stop. Okay, so 5 handles, and I go and add that. All right, straight away the risk manager says, Mr. Brannigan, you can use 4 contracts. You can go and buy 4 contracts in the S&P and trade this trade strategy that you've got. Okay, now let's see what happens the moment I go and try this exact same trade idea, but I'm going to use the full contract. Okay, so I'm going to go use the full ES. Again, I'm going to use the same stop. Okay, I'm going to use the 20 ticks, exact same stop, 4 handles, and I'm going to go and add that. Straight away, the risk manager says insufficient available risk. In other words, there isn't enough risk for you to stick within your risk parameters to take this trade. Okay, and that's that example I was showing you, that when you're trading full contracts and you've got a relatively small balance or relatively small trading account, the reality is you're not going to be able to take many strategies on. Right, so for that simple reason, it makes no sense to be on the full contracts. Now, some of you Tradelo traders, you may be seeing this guardrail pop up, insufficient available risk, and that simply means you're probably trading the full contract and you shouldn't be, or you're not yet at that stage where it makes sense to trade the full contract. Okay? Now, what I do advise traders, and I see this mistake so many times, what traders will do is rather than switch from the full to the micro, they'll say, well, you know what, maybe I'll just go and edit the stop. So maybe I'll take the stop down to 15 ticks. Okay, that is single-handedly the worst thing you can do. Do not change the strategy to match the risk model. Okay, you've put a risk model in place first and foremost. And if your strategy doesn't align with it, then you need to adjust either your account balance. So you either need to increase your account balance or you need to increase your daily stop. Okay, you do not change the strategy itself to match and to be able to take the trades. It makes absolutely no sense. Okay, what's going to end up happening, you are going to skew probabilities and you're going to see your expectancy start to turn negative. Okay, so that's the first example. Now let's go and remove this. And what I want to do now is I actually want to go and execute a trade in the ES. So I want to go and show you what happens when we do go and execute a trade in the ES in the full contract. Okay, again, we are going to use that same stop. Okay, so we're going to use the same stop, and what I want to draw your attention to is our available risk. In other words, we have a daily stop of $1,163, and I think you can all agree that that's a relatively decent size stop for a trading account. Okay, now let's go and put just one lot live and see what happens. Let's see how much of our risk we allocate to this. Okay, so we can see straight away $250 is being allocated to this one single trade. Now, that doesn't sound like a lot, but in essence, what it means is that we can only do 4 of these trades or get 4 of these trades wrong on the day, and we're done for the day. We finished. Now, if you're a scalper, okay, that is just makes absolutely no sense, because it means you're going to run out of risk very quickly before you actually start to get the trades that will make you money on the day. Okay, so that's ultimately the result of it. Let's go and exit this trade and we'll take a small $100 winner. Okay, now the next thing I want to show you is what happens when we go and do multiple trades, multiple micro lots. Okay, now in this instance, what I want to do is I want to go again, use the same 20 tick stop. We get the same risk position. Okay, now if I want to go and add gold, okay, I want to trade the gold micros, exact same thing. In the gold, we're going to use a 50 tick stop because gold is quite volatile, so we need 50 ticks or $5 stop. And again, we go and add this trade. Okay, now straight away you can see the risk manager is just following a predetermined risk strategy, and it's telling me straight away you can go and execute your 4 lots in the S&P, and straight away you can go and execute your 2 lots in the gold market. Okay, in other words, it's allowing me to trade multiple contracts at the same time, all within a predetermined risk strategy. Okay, finally, and this is the key, and it's one of the things I struggled with, and most traders who trade full contracts struggle with a lot. Okay, let's say, for example, I start to approach my stop on the day. So what we can see is that our daily stop is just around 1,100. Okay, we're approaching it, in other words, and this is what I want to show you. Now, typically what happens if you're trading a full contract, there's just no possibility that you can take any more trades. Okay, it's not possible, because one contract with even a small stop is going to equate to quite a lot of dollars. Okay, so in other words, with full contracts, as you start to get closer towards that daily stop, the reality is you're not going to be able to take those trades because your risk strategy is preventing you. When you do the micros, however, because it's 1/10 of the exposure, you can effectively fully utilize your available risk. Why? Because of the increments. In other words, even though I'm very close to my daily stop, okay, I can still take on 9 micros for this next trade. So you fully utilize your risk when trading micros versus the full contracts. Okay, that's all I wanted to just show you is the advantages of the micro versus the full. Now, let's get on to the other side of the coin, because it's not all rosy. It's not all, picture perfect and the CME has created this wonderful thing for us. There are drawbacks, and this is what you have to understand when determining how to make that transition. Okay? The first disadvantage is limited profit potential. Okay? In other words, if you have dreams and aspirations of taking a trading account from 2K to 100K, you're not going to do it on a micro account very easily. The reality is the numbers and the math will ultimately prove to be very difficult to have that sort of return schedule. Okay, so when you're in the micros, you do limit the profit potential. Okay, the next one is liquidity concerns. All right, now what I would say is, remember, some micro futures contracts don't have as much trading volume. Okay, and as a result of that, in some instances, when it becomes volatile, for example, if you're trading non-farm payrolls or you're trading the central banks, liquidity in the micros is different to the full contracts. Okay, so just be aware of that. There are times in the micros where you are going to cross the spread. In other words, you're not getting optimal price entry versus if you were trading the full contract. Now, what I will say is typically the exchanges won't provide a micro contract unless there is quite a bit of weight behind it. In other words, unless there is quite a lot of traders that will end up trading it. So by and large, if the CME is providing the product, it's because they believe there is sufficient liquidity. And this sort of concern of illiquidity is something that will most likely only ever happen when the markets become extremely volatile. Okay. The next one then is market volatility. Okay, keep in mind futures markets are very volatile, and trading micros carries the exact same risk as trading the standard contract. Okay, so you can effectively see the micros go to zero. All right, like we saw in oil back in 2020, it went negative. It's the same thing in micros. Okay, they can be extremely volatile. Even though you're only risking 1/10 of it, you can lose more than what's in your trading account. Okay, and then lastly, cost, and this is the key. Cost is particularly important, and this is a massive disadvantage when it comes to trading the micros, and this is where I'm going to go now. I want to show you the math behind the costs involved with trading micros so that you understand the key drawback behind trading micros versus the full. Okay, what you're looking at in the bottom of this slide is you're looking at a schedule that comes from probably the number one broker in terms of, or the number one retail futures broker. Okay, and it's not to say they're a bad broker. In fact, they're a fantastic broker. Okay, I've just taken this for illustrative purposes. Now what you can see is if you're trading the micros, and we're going to look at this last column because that's the in and out. Now in other words, that's a one lot in and a one lot out. In other words, a full round trip. Okay, now for every one lot you go in and out of the market in the micros, it's going to cost you a total of $1.20. Okay, and that's all costs. That's all your associated costs with trading in the MES. Now, if we compare that to the full contract, it's $3.90. Okay, now hopefully you can all see straight away where the catch is here. Effectively, our fixed cost of operating in the micros versus the ES, it's $1.20 versus $3.90. In other words, trading the micros represents 1/3 of the cost of trading the full, but we only get 1/10 of the exposure. Okay, and in a minute I'm going to show you a little bit of math of why this matters tremendously, but in essence, we only get 1/10 of the potential upside, but it costs us 3 times as much to get that exposure. Okay, now let's look at the example so you understand the numbers. If I was to trade 100 trades, so I did 100 times over the month, I executed a one lot in the E-mini S&P 500, and over the course of the month, I made 50 ticks. Okay, so I had a good month, I made 50 prices. Okay, that equates to a profit of $2,500. Now the cost, or the total cost of executing that, would be $390, and my profit after cost is $2,100. Okay, that's trading the full E-mini S&P micro, full E-mini S&P 500 futures. Okay. Now let's look what happens if I was to do the exact same exposure. In other words, I expose myself to the same nominal amount as I would in the E-mini S&P. Okay, so for every one lot in the full contract, it's 10 micros. So same thing. On 100 occasions, I trade a 10 lot in the micros. And again, I make 50 prices over the course of the month. So exact same scenario, I make 50 tick profit, but instead of using a one lot in the full contract, I use 10 lots in the micro. Now in this instance, we have the same profit, 2,500, okay? We can see it there. However, this time our cost is 3 times as much because we have to pay 3 times the cost to have the exposure to the micros. What does that do to our profits? Okay? And that's the key, and that's kind of, and I'm being a bit facetious here where I'm going, and the winner is, who wins in this situation? Well, I can tell you right now, it's the broker and the exchange. Okay, so yes, they created this product, the exchange, and it's a fantastic product and it's got a lot of upside, and I encourage most traders to use it. But it's important to understand this key drawback, which is you should not be staying on the micros forever because it massively eats into your profits. Okay? Now, let's go and have a look at what are the factors. There are 6 determining factors to make that switch. Okay? Now, the conclusion I wanted to just share with you before I go through these factors is that micros are not suitable for high turnover trader. If you class yourself as a scalper and you're doing a lot of round trips a day, you are going to be eaten alive trading the micros. Okay. Now there isn't a hypothetical number of trades where it makes sense. Okay. I'm not going to say to you, if you trade more than 50 micros per day on average, then switch to full. No, it doesn't work like that. It's not as linear as that in terms of advice. Now, because there is upside to trading the micros, as I've shared with you, I've showed you those advantages, right? What we have to do is we have to weigh up the upside and match that against ultimately the drawbacks. Okay, we have to kind of make that transition only when it makes sense. Now, there are 6 factors to consider that'll enable you to determine when to make that switch. Number 1, as I've just spoken about, is level of activity. If you trade a lot and you do a lot of round trips and you want to be a scalper, in, out, in, out, in, out, you do not want to be trading micros. Okay, that's priority number 1, is level of activity. The next priority is account size. Okay, if you do not have a minimum of $10,000, stay on micros. Okay, as a bare bones rule of thumb, do not trade full contracts on less than $10,000. It doesn't make sense in the long run. You are going to have significant drawdowns. At some point, you'll blow up. You won't have sufficient runway to ultimately grow a trading account. Okay, that's priority number 2. Number 3, where are you at in your career development? This is key. If you're in that first 2 years of your career, stay with the micros. Why? Because remember what I said. The last advantage is you get to learn cheaply. You get to expose yourself to lots of different markets. Okay, remember, in your first 2 years of trading, it's not about making money. It's about making experiences. Okay, you've got to pay to learn this game. So if you're in your first 2 years, stay on the micros, because guess what? The cost is justified. Because you get to be in a live environment, you get to understand and develop yourself as a trader, and you get to do it all cheaply without the risk of blowing yourself up. Okay, and that's worth its pound in gold. Because if you can survive those first 2 years, all that additional money you gave over to the exchange and the broker was money very, very well spent. Okay, because you're guaranteed not to blow up. Number 4, your strategy type. Okay. Depending on the type of strategies you adopt, if you've got strategies that have got very wide stops, you're probably going to be leaning towards micros. If you're more of a momentum flow-based trader, you're going to be leaning towards the full contracts. Okay. Also win rate. If you have trades that have got a very low win rate, maybe 10, 15%, the reality is you're probably going to have wider stops, which means you're going to be most likely trading micros. Okay. Also, if you're someone that wants to scale in and out of trades, okay, that flexibility, if you're someone that likes that flexibility, you're going to gear more towards micros versus full contracts. Number 5, priority. What are your trading objectives? Okay, if you want to make 10% returns, your objective is going to be very different to making 100% returns. Why? Because remember what I said, you're not going to take a $2,000 account and turn it into $100,000 trading the micros. It just won't work. Okay, and then finally, what is your style of trading? Okay, I think I spoke a little bit about this with regards to strategies, but again, if you're more of a swing trader, you're going to be leaning more towards micros. Why? Because you can massage the positions, you can add to it, you can trail stops, you can do all sorts of nimble kind of things. Okay, if you're a scalper, okay, guess what? You need to be on the full contracts, assuming your account size is greater than 10K. Okay, now, if any of the Tradelo traders want to discuss this further in detail with me, just message me in the Discord channel, okay? I will give you further guidance about the right time to make those transitions. There is a right time. It is very individualistic, and it's based on these 6 key factors. I will take you through these exact 6 factors. I'll understand where you are and give you that sort of timeline guidance.